Hey guys, thanks for joining me for this one. In this video, we're going to go through 12 stocks that just hit their 52-week high today in the market. Now, if you like this type of content, please be sure to subscribe to the channel, hit the thumbs up button for the YouTube algorithm, and also let me know in the comments if you have any thoughts, opinions, or if you own any of these stocks. Would love to hear from you guys. Okay, so before just jumping into the 12 stocks, I just wanted to talk about stocks at their 52-week high because generally I think lots of people like to average down on positions, dollar cost average as stocks go down, or like to buy stocks that are closer to 52-week lows. But depending on the situation, sometimes stocks are at 52-week highs for a reason. Now, that could be just a lot of hype or reasons that you shouldn't be buying a stock behind. But sometimes there's actually good reasons to buy a stock at a 52-week high. So I'm not going to go overly deep because it's 12 different stocks we're going to talk today. But I will take a peek at their earnings forecast. And if I do think any of these companies are worth doing more research on, in my opinion, for my portfolio. So the first stock that is at a 52-week high is Nvidia Corporation. So Nvidia is a technology company in the US that they play a lot in like chips and stuff like that. Very high flying tech company, moves around a lot. What's crazy is this company's now a $700 billion company, but just this year, which is literally 3 months, the company has doubled. So the company's value has gone up over $300 billion in one quarter, which is crazy for a company of this size and magnitude. Looking back a bit, though, you can kind of see these wild swings. Nvidia from 2019 almost 10x'd from 2019 to 2021 before getting cut in half. Now back on the rise, closer to its all-time high. So there's lots going on here. I'm not going to cut it in every single way, but just looking at the company from a earnings perspective, this company is projected to earn about $4.50 in the current year, $6 next year. So as I just look at the earnings, that's about 45 times next year's earnings. And I'm sure they have a lot of really high growth categories and segments that they play in. But just when I look at opportunities in the market today on solid businesses to buy under a 20 times earnings today, it's really hard for me to pay up 45, 50, 60, 70 times for current year on Nvidia. And the growth rate in the outgoing years has to be really high to get me a better current value of my capital than putting it into a stock at like a 10 or a 15 times earnings, even if it has a much lower growth profile. So for me, I'm sure this is a great company doing a lot of great things. Admittedly, I don't know every facet of their business, but just from a price to earnings multiple, I do not own a stock that's this expensive in my entire portfolio. And I probably, because of that, would not consider like looking into Nvidia any further. The second stock that just hit a 52-week high today is Wynn Resorts, another one that's kind of been on a wild ride pre-COVID, then COVID drawing it back down. Now it seems like it's getting a lot of traction behind traveling, returning. Seems like there's lots of increased gambling going on in Macau, which is where they have a lot of their business. Kind of see the first article here. Wynn Resort stock rises on return of tourist traffic. But this stock has really been bouncing around over the last couple of years, still significantly behind where they were in like 2018, 2019 to a lesser extent. But year to date, this stock's roaring up over 30% in 3 months. So people have done really well with this stock that have held it so far this year. And this is one that as we look at their earnings, bear with me, they're only projected to make about $1 this year. You can look at high side, has them at $3.30. Low side has them at losing money. So even if I take high side, the company's trading 35 times earnings. Obviously, if I take the average estimate, they're trading at 100 times earnings. But then for next year, average is about $4. So they're trading closer to, 26, 27 times earnings next year. So, similar thoughts versus Nvidia to a lesser extent. it's like for the amount of risk that comes with owning a gambling company and all the competition and everything that can go wrong in the economy, etc., with China exposure, I just don't get why I would invest in a name trading 26, 27 times next year's earnings. Feels like there's much lower multiples on much less risky investments that I can get today in the market. So another one, while I'm sure it's a great company, um, great entertainment business, etc., not one that I'm looking at adding to my watch list here at 52 week highs. Mondelez, this is the first kind of consumer products company we're looking at. There's a handful of them on the list here, and they've done really well as of late. I think last year they were kind of weighed down because of margin pressures, shipping costs going up, just inflation across the board. But now they've really started to bounce back, displayed a lot of pricing power, and lots of these companies have seen volume not fall off too much despite broader economic headwinds. So we're seeing their price to earnings kind of valuations go back up to where they were before. We look at Mondelez here, not too high on the year, just up 6%. But if we look at their last 1 year, they've been pretty stable with a lot of volatility in the broader market, hitting a 52-week high today at about $95 billion valuation. Now, their price to earnings says 35 times here, but when we look at the analyst estimates, it has them at about $3 current year, closer to $3.50 next year. So they're trading at about a 23, 24 times current year, 21 times next year earnings. I think that's pretty fair given where lots of their competitors trade. So this is a stock, while I have some exposure in this general space, I think is deserving of their 52-week high, and their valuation seems reasonable for what this business is delivering. You also get a nice little dividend there as well. The next stock number 4 that hit a 52-week high today is Oracle. So Oracle so far this year, similar to Mondelez, hasn't really been taking off like Nvidia doubling or anything like that, but they've performed pretty well over the last year to date, and then also the last year in general. And they've recently broke out here. Seems like, funny enough, they just expanded a partnership with Nvidia. It looks like that's what this little jump that put them really over the edge to a 52-week high is. But their business in cloud and everything else has just been relatively strong, humming along recently. So looking at their earnings, they're projected to do about $5 this year, $5.50 next year. So that's actually significantly, and maybe that number, no, it looks like it's accurate. Puts them at about 19 times current year, 18 times or 17 times next year's earnings, which feels low. So I would definitely do some research for yourselves if you're interested in this company. I may look into it further to see if that's a real analyst estimate or analyst consensus, because I feel like under 20 times for Oracle is significantly lower than they've typically traded. But nonetheless, if that's the case, this is another one that, despite being at a 52-week high, may be deserving of that title and still worth looking into. Okay, stock number 5 at a 52-week high is Monster Beverage Corp. Similar to Mondelez, and there will be more of these on the list, these stocks have really held up a lot better than lots of other companies, been able to display pricing power, not see volume drop off too dramatically, and we're seeing them trading at a $56 billion valuation. Just as a pause, I find it unbelievable that Monster Beverage is a $56 billion company. That's huge. I would have never guessed that they were that large, maybe 10, 20 billion, sure. I didn't know they were at this scale, so good for them. And they seem to have earnings to back it because they're trading at a reasonable valuation for the space they play in. So just surprising in general. But looking at their forward-looking earnings from analysts, they think they're going to earn about $1.50 this year, $1.75 next year. So, that looks like it equates to 32, 33 times this year, and then something maybe in the high 20s next year. So looks like a bit richer of a valuation than Google Finance is pulling through. Maybe they had like a one-time help in the base or something trailing 12 months. Sometimes you can see down here. No, it doesn't seem like anything jumped out. But nonetheless, company that seems to be executing really well. Global company, lots of brands that they own under it. I see here they're looking at acquiring a new brand, Bang, which I've seen some advertising for before. So while they've executed really well, and I think long term they've done fantastic, yeah, almost like blowing up in the 2010s, stock up 10x give or take. This is one that I don't really feel like I need to own a energy beverage company trading in the 30s PE. So this is one that personally won't be looking at, but all the credit to this company and to their shareholders who've been holding on throughout all of this. Okay, stock number 6, I believe, that is at their 52-week high. Unilever. So very similar story to some of the other consumer companies that we talked to. Unilever has kind of weathered the storm pretty well over the last year or two. This company specifically has had a really hard time longer term. They've had some change in leadership, some missteps, but they've really weathered the storm well over the last year, and they've recently broken out with the rest of the industry here to achieve 52-week highs. In terms of their valuations, their valuation is still pretty reasonable. If we were looking at, here we go. If we're looking at fiscal year 2023, we're looking at like $2.70 a share. For 2024, about $3 a share. Going back to their earnings, that means they're trading at about 20 times current year, 18 times next year's earnings. Seems very reasonable for a company like this. I think they probably have more European exposure than your average CPG, given they're located out of the UK, I believe, and they may be dealing with lower multiple or lower valuations there because of everything happening in that region of the world. And then they've just had some issues executionally and figuring out exactly what part of their portfolio they want to keep or they want to be playing in long term. So they're probably getting a bit of a discount behind that. But for the long term, this could be a good opportunity on Unilever despite it being at 52-week highs. The next stock at 52-week highs is McDonald's. So this company, over $200 billion valuation on McDonald's. Lots of these companies have had very similar charts. So this reminds me a lot of Unilever here, up in the mid-teens, has really just broken out recently. The rest of these consumer type companies, up about 6-7% on the year, which is enough to hit a 52-week high. What's interesting about McDonald's is they actually have just been announcing a layoff plan. So, you see some of these other companies announce layoffs that have had their stock price, like Meta, Facebook, cut in half or cut down 70%. They have to drive efficiencies. McDonald's stock is at an all-time high. Their earnings are super healthy. They have record years in the forecast in terms of EPS, and they're still cutting people. So, you can look at that as being very diligent from a shareholder point of view, or you can look at it a bit negatively in terms of how they're managing their employee force and their business. But I just thought that was noteworthy to have this kind of news on a day that the stock just hit, I think, an all-time high at 282. So interesting. Full disclosure, I actually do own McDonald's shares. I own them, in the late 20, like 17, 18, 19s. And I stopped buying them. Then during COVID, when COVID first hit, I was buying a bunch in the 130s, 140s. I think essentially doubled my position. And I haven't really been buying much since, because then the stock immediately went up. Now it's over 100% higher than where I was averaging in 2020. So this is one that is frankly likely at the top end of its valuation range in terms of what I think it deserves. And it's one that I'm just holding. But it did hit a 52-week high today. Looking at their EPS estimates for 2023, they're looking at doing about $10.50. and then looking at growing about 10% for 2024. So in terms of what that means, they're trading at about a 26 times multiple, give or take, this year, and then going down to about a 24 times multiple next year. Overall, pretty expensive valuation. You're paying mid 20s multiple for a business that isn't growing that fast over the long term, with interest rates at 5-6%. This company is really stretching their PE multiple in terms of what they're demanding. But lots of consumers, or lots of shareholders rather, are looking for safer companies, safer operating businesses, and McDonald's definitely, no matter what happens, should hold up pretty well. So I think they're benefiting from that sentiment. Okay, going into the next stock at a 52-week high here today, Lamb Weston Holdings. So Lamb Weston Holdings, if you didn't know, a bit of a smaller company here. They are essentially one of the world leaders in the production and processing of everything potatoes. So yes, French fries, frozen French fries, waffle fries, other frozen potato products. This is really like a French fry global company. If we look at their earnings, they're projected to about $4 this year, up about 10% next year. So they're trading at about a 26 times valuation this year, 23 to 24 times next year. Very similar valuation to McDonald's. So I guess you can decide if you want the franchise restaurant side of the business, or you want the production of French fry side of the business. But both of them hit a 52-week high here today, valued at $15 billion here on Lamb Weston. Going into the final five, Hershey Corporation hit a 52-week high here today. This company has really been taking off over the last 5 years, compounding over 30% growth rate on their stock and paying a nice little dividend as well. We've just seen a lot of momentum on the business. They really picked up during COVID, lots of comfort food, and it seems like since after COVID, nothing's let up, and they've continued to run, which is really great to see. You can kind of see here on their annual numbers from 2019, they're doing about $8 billion in revenue. In 2022, they grew their business about 30% from that to $10.5 billion. Net income 1.1 to 1.6, so up 30-40% as well. I know they've been doing a lot of acquisitions and breaking into snacking a lot more, not just chocolate. But this is a company that's just executed really well, and they've definitely gotten a price to earnings multiple that's very attractive because of it. Essentially, they're going to do $9.50 this year, $10 a share next year in EPS. Looking at their earnings, they're trading at 26 to 27 times this year, 25 times next year. Very rich for a chocolate company. So same thoughts as like Monster and some of those other names that are trading in these high 20 multiples in terms of my thoughts on whether that valuation is warranted in an environment with interest rates as high as they are. So not one that I'm personally looking at given the valuation, but I think the business is great. Their operation, or from an operating point of view, they're great, and they should continue to do well, I'd imagine, in the coming year. So definitely one that's interesting, just not the right valuation for me. Okay, stock number 9 or 10, I believe, actually. Texas Roadhouse hit their 52-week high today at about $110 a share, over a $7 billion company, $7.3 billion. If we look at just this company over the last 5 years as well, they've done really well for a restaurant stock. Average stock increase per year at about 15%, also paying a nice dividend. I think they just boosted the dividend in a big way as well. If we look at this company over the last number of years, you can kind of see $2.7 billion in 2019. COVID year, they went down about 10%, but then they went to $3.5 billion, so 30% higher than pre-COVID. And then in 2022, they grew another 15-20% on top of that. So this company is growing like crazy. Did about $270 million in earnings. So honestly, very rich valuation. on this stock just by looking at that. Let's look at the analyst expectations on EPS. About 468 a share for current year, 550 for next year. If we go back, they're trading 450, 25-ish times this year, and then maybe 21 times next year. Not as crazy as I thought. I guess there's a lot of growth baked into the expectations for 2023 and 2024 on a net income expansion basis. Maybe they forecasted some margin expansion, but you can definitely get other restaurant companies in the U.S. for low to mid teens, whether that's I don't know. It's lots of restaurants out there that are trading low to mid teens in terms of sit down restaurants like this. But this one's definitely been outgrowing them and has been executing really well on how they're growing the business. So I guess you really have to pay up for that execution and that brand. Stock number 11, who just hit a 52-week high today, is Ulta Beauty. So Ulta Beauty is another one that has just been taking off. So this is also an all-time high, but you can see past 5 years growing at over 30% CAGR growth rate on their stock price. And their multiple is not even crazy, albeit this is a retail stock, but you're looking at their stock multiple here in terms of their earnings per share. They're going to do $25 this year, grow at 10% to $27 next year. So at $25, they're trading at about 22 times earnings for this year. At 27, they're trading at closer to 20 times for next year. So 22 times earnings this year, 20 times next year for a company that's been able to show they have a proven business model and has grown the business really well over the past 5 years. Still reasonable, or just still not a massive company in the grand scheme of things at about $28 billion. But it's getting there in terms of size. I'm not sure how much they can keep compounding at this rate, just from a law of large number standpoint. But I was surprised to see this stock trading at a forward earnings of 20, just given how fast this stock's gone up, right? So this one's an interesting play, but you can get retail stocks for significantly cheaper that have lower growth rates. For example, I was talking Walgreens a couple days ago, trading at 7 to 8 times earnings, paying a 6% dividend. So you can kind of pick your poison on if you want the growth and the high return on invested capital like Ulta, you're going to pay a premium for that. Or you can go for a company like Walgreens, more stable, not growing as fast, but you're going to get a juicy dividend yield and maybe some share buybacks with it too. So to each their own. The last stock today that hit a 52-week high is Booking Holdings. So year to date, bookings up over 30%. If we look over the last year, let's call it, they haven't been doing overly well. They really slumped last year behind the sentiment around the economy, but it's been clear, at least so far this year, with Airbnb's earnings and stuff like that, and probably Booking's earnings as well, obviously, that people are prioritizing travel. They're still traveling more than ever, and that's really been reflected in the stock price, hitting a 52-week high here today and up over 30% on the year. Booking's another one. I did not know Booking was a $100 billion company, so that was new to me. That was really interesting, bigger than any of the hotel companies, as they kind of like are an aggregator of hotel deals. You can kind of see some of the brands they own here: Booking.com, Priceline, Kayak, cheap flights, rental cards, etc. Oh, I didn't know they own OpenTable. Interesting. So just looking at their valuation, so it's expected that they're going to own about $130 a share this year, $150 next year. On $150, this stock is trading at a multiple of about 17 to 18. So 17 to 18 bucks. 17 to 18 times earnings for next year. On $150, they're trading. Was that what they were doing this year? Sorry, I lost my math. Oh, $130 rather. They're trading just over 20. So 21 times current earnings, 18 times future earnings. Decently valued in the grand scheme of things, as long as you believe travel is going to keep coming and flow through websites and channels like they own Priceline, Kayak, Booking, etc. So I know it's a big jump to see and a big price to pay, and absolute share price too. I'm surprised they haven't done a share split or anything. But overall, this is another company that seems like it's not in a bad spot from just a general market price to earnings versus the competitors in the space and given the category that they play in. So those are 12 stocks today that just hit their all-time highs. I hope you guys got some value out of me highlighting these. Hope you tagged one or two of these to potentially put on your watch list to look at a bit more. If you like this type of content, please subscribe to the channel. Give the video a thumbs up if you're still watching. It really does help with the YouTube algorithm and get the video out to more people. And if you have subscribed to the channel, would love to hear from you in the comments, even if you just want to say hello, or if you own or have any thoughts on these companies, would also love to hear from you. Thank you guys, and I'll see you in the next one.